Thanks for joining us this morning. My name is Murray Anderson, based in Cape Town, Prescient. With me today is Tian Pan in our Shanghai office in China, and we'll be covering our China webinar Q3 2026 with a beautiful picture of Shanghai on the presentation pack that's showing. This morning, Tian will be covering, as we usually do, the backdrop in which we're managing our investments based out of China. He'll be covering the China Balanced Fund and the China Equity Fund. And obviously, today we need to cover the backdrop of investment markets, which are governed really by the geopolitical nature of what's going on in the world, particularly, I guess, the Straits of Hormuz, energy prices, and the like. So Tian, thanks very much for your time this morning. We've got a good number of people joining as we do a calculation here. We're just over 200, which is very exciting. And again, thanks everybody for joining. Obviously, this is an exciting topic. Lots of moving parts to investment cases around the world based, as I said, off this geopolitical nature. But today, obviously, what we'll be talking about is the relationship between China and the US and everything in between. So Tian, without further ado, let's have a view on the geopolitics and the economy based in China.
Great, thanks, Murray. And yeah, morning, everyone. Glad to have you with us this Monday morning. I think just before I jump in, I think there's a question Q&A function that you guys can all access. So as I go along, if you have any questions, please feel to pop it in, and then we will try and answer it all at the end of this presentation. Not a long one today. Actually, not too many developments, but since our last webinar, some proactive developments, especially on China-US relations. Trump made his official state visit to Beijing in May. So it's been quite a few months ago, but it wasn't covered in our last webinar, and a lot of developments since. But I think the key of the slide is trying to say that rather than expecting anything hugely positive between China and US relations, the underlying rivalry pretty much remains, whether it's in the tech space, whether it's in the military space. And Trump's visit was largely to sort of have open channels of communication to ensure that there's damage control in the fierce competition between the two superpowers. And I think overall stability is the focus, rather than sort of massive rollbacks of tariffs and the two countries becoming best friends again. So that's pretty much our base case view, and we pretty much saw that. So the initial reaction to the state visit was quite disappointing. There were quite a lot of lack of specifics, no real mention of or clarity on the Iran war, China's participation, no real mention of Taiwan, which was heavily sort of rumored prior to the meetings. There were potential purchases of US agricultural products, but there were no specific numbers given. Disappointing 200 Boeing jets were mentioned to be ordered. We didn't know, we probably still don't know the exact makeup. Is it a small aircraft? Is it the larger 787s or the smaller 737s? Original estimates prior to Trump's state visit were at 500 Boeing jets. So there's still a lot of room for improvement on the positive side, but initially there were quite a lot of disappointment. So some of you may remember that NVIDIA CEO Jensen Huang was a last-minute addition to Trump's Air Force One traveling to Beijing at the time. And NVIDIA's stock price temporarily did really well. But unfortunately, if we look at what's happened since, Chinese companies are still actually choosing not to buy NVIDIA chips, partly because they're still not able to purchase the most powerful NVIDIA chips. China is now, or the US is now willing to sell the second most powerful range of NVIDIA chips, not sort of the most powerful Blackwell series. And China is actually choosing not to buy, choosing more to focus on their own homegrown produced AI chips, which is actually unfortunate, but we are seeing more and more of a decoupling in the AI space. But it wasn't all negative news, so to say. So positive signs did eventually emerge. Actually, towards late May, after Trump returned to the US, we saw an indefinite pause on $14 billion worth of arms sales to Taiwan. The reason used was the war in Iran, pretty much the US needing to prioritize its own sort of arms and ammunition usage. Whatever the reason given, the fact that the arms sales has been paused indefinitely is a positive sign for bilateral relations between China and the US. And then China gave specific numbers. So initially committing to about $17 billion worth of purchases of US agricultural products. And then we saw then in July accelerated purchase of US soybeans, and now US beef and poultry is now officially allowed to be freely imported into China again. So quite a lot of positive developments on sort of the Republican support base, and pretty much Xi Jinping most likely a positive gesture after his meeting with Trump. In terms of the war with Iran, there's been a lot of ups and downs, and today is actually sort of the last day where the MOU, the Memorandum of Understanding, is due to expire. So where we saw China really helping with the Iran war was that if any of you have ever done business in China and dealt with Chinese businesses, the MOU framework is a very Chinese concept where an intention to a ceasefire in this case is written down, but because there's nothing concrete that can be agreed. The MOU is more just a document of intention, positive direction, but unfortunately, in hindsight, we saw that the actual ceasefire only lasted around 48 hours before sort of bombing resumed, and then pauses again, and then resuming bombing. So everything with Iran, we believe there's still a lot of work behind the scenes, but unfortunately, we don't see a clear end to it right now. So the last positive point on the slide is that with all the chaos happening, we do see warming relations between China and the US. And Trump obviously officially inviting Xi Jinping to the US for a state visit in autumn. So rumors are that sometime next month, the Chinese president will visit the US. We are waiting to see. Any visit will mean there will be positive political developments between the two. So we are nowhere, again, I think we reiterate what we said in the first quarter's webinar, is that we expect nowhere near the type of trade and sanction tension that we saw this time last year. Remember, a year ago, we were still sort of in the midst of the Liberation Day tariffs and triple-digit tariffs between China and the US. So everything is much, much more positive this year. And the last slide on this section of the presentation is I wanted to show China's diversified energy mix. So China's still heavily dependent. So all of these numbers are slightly outdated, but the proportional makeup quite recent. So quite representative. So if we look at overall oil and oil related, around 18% of China's overall energy mix. And if we look at the sort of Strait of Hormuz exposure, it's around 6%. So if we assume the worst case scenario, everything really stopping in the Strait of Hormuz, then China still has sort of very easy access to the other 94% of its entire energy bar. So it's nowhere near as catastrophic as some other economies heavily dependent on Strait of Hormuz. So if we look at Southeast Asian nations, if we look at Japan and South Korea, who import all of their oil, they are going to run into trouble a lot quicker. Even economies like India. So before China runs into problems, we expect to see countries like India, South Korea, Japan run into problems. So there's not too much worry in terms of the energy, supposed energy crisis from the Strait of Hormuz. It's not ideal. It is driving up global oil prices. And then another point I want to mention, which we mentioned in our Q1 webinar, is that Chinese vessels are probably the least impacted on a relative basis. Still hugely impacted, but Chinese vessels are the least impacted transiting through the Strait of Hormuz, given the special relationship between China and Iran. So overall, energy replacements from Canada and Russia can largely replace the sort of temporary, we hope temporary disruptions from Iran from a China perspective. From a US perspective, actually, the US is selling a lot more oil into Japan and South Korea. So US oil companies actually benefiting from additional volumes and higher prices throughout this war in Iran. So another one of the factors that contributes to our view that it's going to be difficult to end the war quickly. But with that in mind, we move on to the actual numbers for China. All of these numbers are as up to date as largely July. Some of them are slightly older because some of the data are actually only coming out today, which is not updated in the stats. But the trend is very, very clear. The first slide, we look at how the Chinese currency has performed relative to other safe havens. So the dark navy line on this slide is the rand. The rand is only included for reference purposes. It's obviously quite an emerging market proxy currency. You can see this is since the war in Iran began. The charts start from 27th of Feb, when rumors of the war in Iran was already pretty much starting to be priced into the markets. And you saw the rand blow out quite strongly in the initial phases, then coming back, and then sort of quite a lot of volatility in the rand. The red line is the euro, and the purple line is the sterling. So you can see those hard currencies pretty much rock solid, so supposedly rock solid currencies that historically have low volatility they were both very volatile for developed market currencies. So at one stage, as at the end of June, the sterling and the euro depreciated against the dollar by sort of 2 to 3% on average, and the euro actually depreciating relative to the dollar more than the rand had by the end of June. By the end of July, quite a lot has come back. August is still a bit of an up and down month, but the rand's actually done well. Both currencies are coming back. But I think the standout line on this chart is the green line, and that's the CNY. So the CNY, the Chinese yuan, is now, flows are more and more indicating that it is a safe haven currency. So throughout the entire war, volatility was largely muted, and since the 27th of Feb until the end of July, the CNY has appreciated 1.6% versus a very strong dollar. So relative to the euro, for example, the CNY actually appreciating by 4%, versus the sterling appreciating by close to 2% since the war in Iran started. So very, very strong numbers. And again, another sign that the Chinese financial markets are where global flows turn to in times of chaos. If we look at stock market performance, we saw massive divergences. This is something we covered in our quarterly commentary for July. But this chart shows we saw massive divergences. This is since the war in Iran began. The onshore equity markets actually rallied. That was quite positive, although the last few weeks have been quite a struggle for the Chinese equity markets and the onshore market, but largely a convergence. So we saw massive divergence between the onshore and offshore markets. The red line is the onshore CSI 300 index, and the purple line is the global favorite offshore, majority offshore dominated MSCI China, where your Tencent and Alibaba sit, where Chinese tech companies sit. At its peak, there was a 27% year-to-date divergence between the two indices. As at the end of July, the onshore index still outperforming the offshore by about 7.5% in US dollar terms. So still quite big divergence. We continue to see that divergence in August month to date. If we look at the economic data, China GDP for Q2, not very impressive, but largely expected, slightly behind sort of expectations, but we're still going to meet sort of the 4 to 5% GDP growth target. CPI pretty steady above zero, not largely, but definitely helped by higher oil prices. China is in a bit of a deflation cycle, quite concerning, but core inflation is still steady around the 1% mark. And PPI, we're really comfortable with, well, way more comfortable with sort of a lower CPI numbers, seeing that PPI has turned positive for the first time since September 2022. So we've had a couple of months of positive PPI, which means CPI will eventually catch up. So we're quite comfortable that China is largely out of its really deflationary risk cycle currently. So we continue to look forward to better CPI data. Consumption still needs improvement. Retail sales continues to disappoint. In May, it was actually a negative reading, which is very concerning. Retail sales grew unexpectedly, which is positive in June. We still await the July number. exports continue to drive the economy. And the real estate sector, we include here for more for reference purposes. We remain of the view that the real estate sector is still going to be a sort of another 5 to 7 year problem to resolve. Our strategies pretty much have no direct exposure to real estate, less than 1% indirect exposure to the real estate sector. I want to talk a little bit more about retail sales. So the retail sales figure, ideally, we want that number to be higher than 5%. Right now, it's growing, but way below the 5% mark. Why do we want it to be more than 5%? It's because we want China to be an exports-driven economy, exports and manufacturing-driven economy, to more of a consumption-led. It's going to be a long and tough task, given sort of the depressed market sentiment. Youth unemployment, employment are issues in the economy, and the wealth impact by the declining home prices. So we don't expect retail sales to jump, and our view is that the government in China is not going to come out with massive cash fiscal stimulus simply because the Chinese consumers have a lot of cash. It's just that they are not willing to spend. And continued sort of retail consumption subsidies where government pay for 15 to 20% of your purchases, we expect that to remain in place indefinitely to encourage Chinese consumers to consume. So the retail sales numbers will continue to be the numbers we put sort of our lenses on going forward, and we will do more detailed coverage of that most likely in our next quarterly commentary. So this is another chart where we look at the onshore and offshore divergence between the two markets. If we look at, so the previous chart we saw was since the Iran war, but if we look at 2026 year to date, there's pretty much an 11.5% divergence still, as at the end of July. At its peak this year, as at the end of May, June, we at one point hit 27% record divergence. This again speaks to it. Actually, your China investment experience matters a lot, depending on which China you access. It's not simply buying MSCI China. This year was a prime example. If you bought MSCI China this year, you would be down. But if you bought onshore Chinese equities, you would be up. So we think it's very, very important to invest in a strategy that understands both markets and allocates to both. And this is where our strategy comes in. And I'll cover that a little bit later to see, to show how our fund is positioned. But if we look at it from a market perspective, China remains absolutely a bargain relative to the US. So with the little blip in July and August month to date, we actually saw quite a strong recovery in the last few trading sessions in China. China remains at more than a 50% discount in terms of valuation multiple. So you're buying the same stream of earnings in China for less than half the price of what you buy in the US. A lot of our clients have actually taken small allocations away from their global, as in DM US exposure, started allocating to China. And that's probably something that we recommend because valuations in the US are just so high, and one is unsure when that bubble may pop. But China right now is at a very healthy and sustainable valuation where you have a earnings bottom and an earnings multiple bottom. So we expect to double up when the markets do consistently rebound. We expect that for the next few years. Another slide we thought was quite important to mention was that if you look at MSCI Emerging Markets Index, this is the top 10 of the MSCI Emerging Markets Index. So quite a lot of people, so the general trade this year for 2026 is in favor of emerging markets due to the high valuations in developed markets. But if one simply took the MSCI world exposure and just bought it into like an MSCI emerging market concentrator or MSCI emerging market strategy, what you end up buying is, if you look at the top three companies in the MSCI emerging markets make up almost 30% of the index, more than the entire China combined in the index. So bear in mind, China is a $22 trillion market. The top three companies in MSCI emerging markets not only weighs as high as 30% in the index, it is exposed to the exact same inflated AI sector that you're trying to get away from in the US. So buying what strategy you're buying when diversifying away from developed markets to emerging market is extremely important this year. So this is more just an interesting slide to say, please look at what you're buying in emerging markets. You don't want to diversify away from US AI just to buy South Korean, Taiwanese AI-related companies with the same sort of beta and correlation. So yeah, think about this slide, and then I'll move on to our Prescient China strategies. This is our flagship strategy that most of you are invested in. What we did earlier in January was remove China Tech on a massive cut, and we still haven't fully gone back into China Tech. What we started doing is that we started adding back China Tech throughout the second half of second quarter and the earlier part. So we continue to consider and add back China Tech because it had dropped so much and the valuation started becoming very, very attractive. We actually didn't foresee the Iran war, as I previously mentioned back in January. It was more of a relative trade where we thought onshore Chinese equities were way more attractive at the time. Okay, so if we look at how our fund has performed, so the MSCI China is down 7.3% in dollar terms this year. CSI 300 total return up 4%. Our fund has actually done fairly well. So we managed to control volatility well on both on the up. We try and get exposure to upside volatility and control it down. And given the volatility in the markets, as at the end of July, our Prescient China balance actually outperformed both the MSCI China and CSI 300. That is not its performance benchmark. This is just for reference purposes. But over a 7-month period this year, we consistently generated superior returns at lower volatility than these pure equity indices. I'll skip the standard performance chart and move on to the long-term one. Is that we don't just do that in the short term. We've consistently outperformed all of these equity indices since our inception in 2013. So overall, cumulatively, we've beaten the MSCI Emerging Market Total Return Index by 70%. We've beaten the MSCI China Total Return Index by 121% and beaten the CSI 300 Total Return Index by 68%. All of this is net of fees. All of this is net of fees. So if we look at this table, if you guys can see, our highest one-year rolling return is 116.8%, whereas our lowest rolling return is minus 26.97%. And this is exactly sort of the payoff profile the strategy targets. Not that we'll always necessarily achieve it, but we try to target asymmetric returns, whereas we try and capture as much of the market upside as we can, but limit the downside. We do the decent amount of option structuring and protection within a strategy when we do have that risk budget when we've generated alpha. So overall, if we look at our ranking, we're Morningstar. We're consistently Morningstar 5-star rated. Over 1, 3, 5, 10-year periods, we're consistently ranked top 10% in the world. Over 10 years, this is 8th percentile. We rank number 3 in the world. We often rank number 1 over 5 and 10 years. Just that this month end, we ranked, I think this works out to number 3 in the world over 10 years, number 3 in the world over 5 years, and then number 7 over 3 years, and about, number 8, number 8 over 1 year. So shorter term returns, we typically don't rank very highly, but this month end was actually a period where rankings are fairly consistent. So it shows that our strategy is quite robust and does a decent amount of consistent returns. Overall, I think that's pretty much about it. If there are any questions, happy to take questions. Let's try and keep it as interactive as possible.
Hey, thanks, Tian. Yeah, that's a good coverage of what's going on. Certainly, there are 1 or 2 questions. Can I just also note, I did see 1 or 2 hands pop up, but if whoever's got questions, can you rather type them than voicing them over? Thanks. So we do have 1, and then I've got 1 or 2 for you as well, if we don't see any more come through, Tian. 1 relates obviously to the fact that the Iranian war and the cost of gas or oil is inflationary to the rest of the world. And you spoke about, and we all know extremely well, that the exports out of China are significant. So obviously the global consumer is the consumer of goods for the Chinese exported product. But obviously, there's an
Mhm.
inflationary pressure, meaning that that external or global consumer, particularly maybe in the US, is a little bit more under pressure than they had been prior to the Iranian war when oil prices were low. How does that affect I guess the revenues of the China that expects from the global consumer? So it's really a direct
Yeah.
relation to the cost of goods now.
Yeah. So, I mean, a great question. I think, let me go back to the slide. So there's a reason why Chinese exports are increasing by double digits. So, I mean, 19.3% year on year in May and 27%. Those are sort of unseen numbers, even by Chinese standards, or at least unseen for quite a few years. So you're absolutely right. Global inflation is actually quite high. So sort of I don't know the exact English term for it, but the real feel inflation in the US is typically quite a bit higher than the actual US CPI that's published. And that's why, so it's a double-edged sword. So this is where actually China is doing really, really well. So I'll first speak about exports. In that, South Africa is a prime example, so many of you will have first-hand experience in that when there's oil inflation, it drives up transportation costs, it drives up pretty much all of your basic food costs, your agricultural prices. There's quite strong indirect impacts in that. And for the majority of the population, when your absolute necessity inflation goes up, what you have to spend on sort of your more discretionary spending drops. And for example, cars are a prime example. Cars are actually a big portion of people's assets or incomes, and the Chinese cars are coming through, even though, yes, there is inflation relative to what Chinese cars cost previously, but Chinese cars are coming into markets and being sold at half, sometimes a third of their sort of European or European or Japanese equivalents. This is where there's a lot of dominance and quite a lot of fear in foreign governments. So you have EU slapping tariffs of between sort of 27 and 40%. You have the US slapping 100% tariffs on Chinese cars just because their local industries cannot compete. So China is actually, in a large part, its manufacturing sector, a strong beneficiary of sort of global consumer pressures because yes, initially consumers will be reluctant to buy a Chinese brand because it's got a reputation for not being as reliable as your Toyota or your Mercedes or your Volkswagen. But when push comes to shove and it's really a tight cash flow problem, there's pretty much no choice. And the result is actually consumers trying out Chinese brands like Haval in South Africa. There's been really solid feedback, especially for the price. So China's really benefiting from an export perspective, but from a domestic consumption perspective, I think we actually think inflation is actually positive because Chinese consumers do not lack cash. They lack the willingness to spend. If they believe that your computer is going to cost more next year than this year, they will buy one this year. The problem in China is that for the past 3 to 4 years, everything has gotten cheaper every year. It's that standard textbook issue where people just wait for prices to fall further. So that's why inflation is actually quite a positive thing for the domestic Chinese market.
Yeah, Tian, I'm sure everybody on the call just has recognized the number of Chinese vehicles driving in South African streets instead of the typical German, and maybe to an extent, not so much the Japanese, but the Germans, being affected by the Chinese vehicle. And obviously, as you've said, is ultimately the Chinese are exporting deflation, and so goods seem to be relatively cheap. But yeah, I mean, that consumer, the global consumer is important. But the domestic story, as you again stated, and it's clearly, noted around the world, and is the Chinese consumer, if that turns, and particularly the 1.7 trillion or whatever it is dollars on the Chinese balance sheet now in, savings accounts start to be utilized to an even small fraction, that would be supportive of the local economy and certainly share prices moving significantly north from where they are now.
Yeah, absolutely. So that 1 trillion number you mentioned is actually 24 trillion. So it's a massive,
24
massive.
trillion. My
Yeah.
apologies. 24. Okay,
So I'm bullish
that's a
on
proper amount.
the turn. Yeah. Once the Chinese consumer turns. So our estimates were that just during 2026. So a lot of the savings will be in fixed deposits. You don't have access to it. But Our estimates were that just this year, about 10 trillion US dollars of fixed deposits were expected to mature throughout the year. And there was still about 6.5 trillion sitting in call accounts. So the Chinese consumer theoretically has about $16 trillion worth of ammunition, not necessarily just for consumption, but for investment into stock markets, etc., or indirectly via investment products or insurance policies. So we consistently seeing those flows. So yeah, definitely bullish
Okay.
on that front. But, nevertheless, there's still volatility in the markets. It's not just a one-way street.
Tian, we have to cover the AI story and the competition between the US and China. So we've had a couple of questions here, and I'll try and summarize a few of them. But effectively, I guess what's happening is that the race in the models, I mean, if we just think about the Chinese models that have come to market recently and how significantly they are benchmarked against, and if not beating the US models. I mean, there's that at a model level, but also then at a manufacturing base, the chips, and we've seen China, particularly a new company coming to market that has also seemed to be very competitive. And there's a question relating to Apple's purchase of these specific chips, and you mentioned NVIDIA. Maybe just give us a sense of what's going on and what you're picking up there. Is it like obviously TSMC and the likes have some level of dominance, but the Chinese are slowly closing the gap?
Yeah, so I mean, on the part of the question relating to sort of Apple wanting to source chips from Chinese manufacturers, I think what they asked for is that obviously due to in inverted commas, the national security concerns of Apple product users outside of China. I think Apple's request was only for China-destined Apple iPhone models, the ones that are for sale for domestic China. But I think it shows a very strong point that Chinese advanced manufacturing in terms of the AI sector is not just catching up, but pretty much coming to the forefront. So yes, you do have the absolute cutting edge technology where the US is ahead, and that is where the companies have absolute pricing power because there's no alternative. The thing with China is that as soon as there's a Chinese alternative, everybody in the industry knows for the same quality you're going to get a cheaper price. And companies like Apple still have the option to do it because their margins are high. It's a high margin business. And if you have other companies that are running low margin businesses, they pretty much don't have a choice to buy sort of more expensive non-Chinese produced, for example, memory chips. And if you look at Chinese AI models, it's the same. It's the same. So unless you are really doing absolute cutting edge AI processing in terms of coding, etc., if you are using a chatbot, I mean, for example, I think my understanding is a lot of big amounts, the numbers I've seen are 60 to 70% of Silicon Valley startups actually making use of Chinese AI models just because it's so much cheaper and it's the only economically feasible option for startups. So for bigger companies that have massive budgets, it's a different story. Chinese models actually pretty much. So the comments we've seen from tech players in China and globally is that we're quite happy to pay 1/20th or 1/30th of the price for 80% of the product. The Chinese models are probably on average 80 to 90% of what the most advanced US models are doing. And we actually make use of AI models. So for our purposes, I would say our business requires more of that cutting edge capability in terms of building or improving our quantitative research models. So we do make quite a lot of use of the most advanced American models as an example. But for a lot of the basic processing and research tasks, we are also veering towards Chinese models with a lot cheaper cost per token. So we actually had a conversation earlier this morning. So compared to DeepSeek just had a price rise, but even after that price rise, rising of prices a lot more expensive than what they're used to, it still costs way less than what we pay with the equivalent of OpenAI, our OpenAI costs and Anthropic costs, etc. So Overall, I think AI definitely adding value, adding efficiency to our processes, but not at a place where it can replace humans yet in our business.
Tian, okay, we've got a couple more questions. I just want to kind of pick up on, I think predominantly the themes around valuations. You did mention that, if you're looking at the broad market that you would, operate within, there are still good shares to be had from a value perspective. I mean, I guess in the process, if we just talk about the process, part of this is in the systematic approach that we have is to screening out expensive shares versus those that you can buy at better value. Maybe just talk a little bit more to that, and I think you would have seen the questions, and maybe just thread a little bit of your response to the valuation argument here.
Yeah, sure. So I think in terms of our equity model, let me actually go to the valuation slide. So in terms of our equity model, we are very benchmark cognizant because especially for a market like China, if you do not have access or exposure to a PE 100 stock, which subsequently goes to PE 3000, you tend to lag the market quite a lot. And it's not something that happens very infrequently. It actually happens quite frequently in the Chinese market. That's why we believe the quantitative benchmark cognizant approach works. What we try and do is that so specifically within our value factors, we tend to overweight. Right now, we're slightly overweight value in our portfolios, but it doesn't mean that we won't hold stocks on ridiculous valuations. I mean, a simple equivalent in the US would be Tesla, where its valuation multiples are really high. Its revenue and earnings announcements keep disappointing, but the stock keeps going up or staying high. So there's a lot of that also happens in China. And if I could talk a little bit about sort of how our processes work, is that we try and the entire portfolio construction aims to give our investors the same risk as the index, as a construct, but generate consistent bits of alpha period after period. And that talks to our long-term track record. And obviously, in addition to the equity within the strategy, we dynamically allocate across the onshore and offshore equity markets in China, and we can cut off equity quite quickly, go to zero if need be in terms of equity, and be 100% cash if we believe there's something crazy that's going to happen in the market. So yeah, so I think there's a question on CAPE ratios, cyclically adjusted. Let me just have a look. Yeah, so I mean, I don't think I have time to go into sector specific comparisons. I think I don't know who it is, so I'm not sure how we can get back to you. But please feel free to message us your email. We'd be happy to give you some detailed comment. We look at the market as a whole. Obviously, we will not compare this blue line as an example China to the US or India, because its historical averages are very different. So China historically, we would say sort of 18 to 20 is a normalized historically average on a cyclically adjusted basis. If I just quick commentary on sector. So for example, we obviously will normalize every sector. So for example, a state-owned bank on an 8 PE is what we consider expensive, but something that's in the AI hardware sector. So CXMT, the sort of now the most valuable company in China, is running on a forward PE of 20, which doesn't seem high for a sort of supposed high growth company. But if you look at the equivalent global comparison of Samsung, for example, who also does memory chips, it's probably sitting on a 4 forward PE. Obviously, Samsung has a bit more. So these sort of comparisons are also what we look at. Thankfully, CXMT is not really an index, so it gives us some time to study the company a bit more before we add it into our portfolio. But overall, we are very cognizant of market-specific data, and we try and allocate, or we try and analyze and allocate based on actual market-specific data. Murray, are there
Tian?
any more?
Yeah, Tian, I think the question around that's been posed around the energy mix, you showed a slide on just the diverse nature of how China's, spreading the energy mix, solar, renewables, nuclear. I mean, as we've heard, data center build-outs in the US is significant. It's costing a lot of money, and they're trying to ensure that there's enough energy so that the compute power, can keep up to speed, I guess, with this race that we're talking about. But the question
Yeah.
specifically around the nuclear build-out, if you can maybe have a look at that. And I guess the related question is the supply of uranium into the nuclear build out. Is that sustainable, and does that become a bigger component of that energy mix over time? And maybe, you know, if you see that all of that energy, the alternatives or renewables, going into the green and reducing that coal reliance.
Yeah, so you're absolutely right. So China pretty much had a pause on everything nuclear after I think it was the Fukushima sort of
Mm.
tsunami that damaged the Fukushima plant in Japan. I think that was in 2013. Obviously, after quite a long pause, they've decided nuclear is, on a relative basis, the cleanest way to go forward. So China's got absolutely leading the world. So I'll get to give you an idea. I don't exactly know how the 38 reactors you mentioned in the question is going to change the overall energy mix. But as an example, if we look at solar in China, I think we did an analysis over the last 15 years or so. Chinese solar generation capacity grew something like 1,000-fold, but it doesn't even feature on this chart still. So the growth of the sector, we expect nuclear to be massive. What we have seen as targeted sort of goals is that to get nuclear up to double digits at some point in future within the next 1 or 2 5-year plans. So I believe that's the direction we are heading into. In terms of uranium supply, I don't think China, I'm not sure about the import statistics, but so I'll probably be lying to you if I mention any sort of uranium dependency statistics for you, but we'd be happy to look into it. But my initial reaction would be, given China's existing nuclear fleet of power plants and its entire sort of nuclear military program, it shouldn't be short of uranium for commercial purposes. But yeah, I wouldn't be surprised if China imports uranium or its related products from South Africa.
Okay, Tian, just to read off another question. It says, what is the impact of rising global bond yields and growing concerns about the debt levels, especially in developed markets, on China, both in the interest-bearing and equity markets?
Yeah, so I actually don't see that question, so I'm just going to go off on what I heard from you, Mary. So overall debt situations in more concerning in the US. I mean, we saw 30-year rates hitting sort of 5.3% nominal. US inflation is actually largely under control. It's not really it's not in sort of an ideal space, so still sort of between the 2 and 3% range. But short-term rates are higher than inflation. If we look at the track record of the Fed, they've got a consistent track record of really keeping inflation in check. So we pretty much not too concerned. From a Chinese perspective, specifically, we finding dollar, obviously dollar fixed income. It's not just a pure yield play, but dollar fixed income sort of market has a lot more diverse opportunities than what China offers. It's a lot more mature and transparent as well. Although we don't know, given it's a China fund, we don't really look at dollar fixed income. We try and focus on if it's on CNY fixed income. Chinese 2-year yields are very, very low. So we are happy if we can get sort of 1.5 to 1.6% with relatively good credit quality, as in like strong investment grade paper here. Chinese yields are very, very low, but the market is pricing in strong Chinese currency appreciation versus the dollar, which probably makes sense given the dollar's situation. But that is all textbook economy and sort of currency movements that all of you would have seen in the last few years. When you throw Liberation Day tariffs in, when you throw Russia-Ukraine war in, and when you throw in the war in Iran, all of these textbooks relationships do not hold. And if we have sort of escalation in the Middle East, there will be global flight to dollars, and there will be global flight into US bonds. So there are too many uncertainties related to that. But I mean, from a textbook perspective, US yields are looking very attractive. Debt is an issue, but one cannot be certain that the US economy cannot grow its way out of the current debt problem. So the US economy is still growing strong, very strong for its size, actually.
Tian, you mentioned the sort of the overhang of the property sector in China, and obviously again that has been a big point that I think most people consider as dragging the economy, particularly the investor sentiment in China. It's been a few years now, and is that working itself out of the system? What's the prospects for this debt, the property debt, and the impact on Chinese banks?
Yeah, so I think there's nothing really new there, nothing exciting. Is that government's pretty much consistent with their managed decline sort of intervention. So property markets are allowed to fall, but they're not allowed to crash. So we've seen this gradual managed decline across the board in property-related sector, something that's painful, but the market can bear, and we continue to expect that until it reaches sort of an equilibrium where prices and demand, prices are sort of meeting demand, etc., of a depressed Chinese consumer. So I think we're still a couple of years away. But we don't really have any doubts on the problem eventually getting resolved. It's just that our strategies are staying clear of that sector because it's just not doing well currently.
Tian, often we talk about this, and we talk about tier 1, tier 2, and tier 3 cities. I mean, just from a Shanghai, Beijing, and the major centers. I mean, we talk about property, but you often share, and maybe just give us an update, is the cost of property in those major centers where you've got huge population, you've got sort of a growing wealth effect. Yes, maybe things aren't all as rosy as you'd like them to be, but the cost of property in those major centers is still significantly expensive.
Yeah, sure, absolutely expensive. So I'd say from its peak, there's probably been sort of a 30% decline in property prices in Shanghai, where our offices are based. So out the windows, the sun. We're still looking at probably, on average, for newer properties that one would want to move into. You still probably look at 350,000 rand to 450,000 rand per square meter. And that includes your walls and elevator shafts, and so you actually don't get that full 1 square meter. So that's tier 1. Although it's sort of your lower tier cities, you're starting to get sort of square meterage of maybe less than 30,000 rand. So there's a massive gap. It's almost like the wealth inequality. But even at sort of 30 to 50,000 rand per square meter, people are choosing not to buy because rentals are also just so much cheaper. So the entire market is pretty depressed. And maybe I'll answer this question from Nico, and sort of the state of the Chinese banks is that the Chinese banks are actually all fine. The banks were very smart, many probably 5-7 years ago, to offload. So pretty much like the US subprime crisis, they packaged everything and then sold it off onto high net worth retail investors. So we've actually seen a lot of the props. So these are in China, they call trust products. We've seen a lot of defaults of trust investment products that cost retail high net worth investors millions and millions in CNY. And that we believe is another contributing factor because that group of demographic is typically the high spenders in your economy. That's again the people that are able to spend. If you have 20 million rand that invest, and all of a sudden one of the investments blew up and you lost 8 of your 20, you still have 12 million rand, you're still very wealthy, but you're not going to go buy the same expensive things that you would have had if you hadn't lost that 8 million rand. And that's that psychological. It's difficult to quantify, but we believe it's a strong contributing factor. But our view on the Chinese banks is that the banks are rock solid. So if you look at Chinese bank performance over the last 5 years, it's outperformed the index significantly since 2021. It's way outperformed the index. So the market is quite efficient from that perspective.
Okay. Tian, I think just to start to close off, we've had lots of sort of discussion. I think the interest is around AI, the race that we keep talking about with these models and where it all ends up. And I think we could go on for quite some time on all of this, but maybe just to bring it back to the product mix that we have from a South African investor perspective, taking money from South Africa offshore and investing in this exciting market in China. You often sort of talk about the preferred product is probably the balanced fund. Maybe just cover again for those that aren't on the call that aren't as aware of exactly what the balanced fund is. Just describe that for us, if you don't mind. And then there's a question around access, which I'll cover while you get there. So just from an access perspective, we have the fund listed on most of the international platforms. I know there was a question with respect to something like Swissquote or some of the others that are not linked directly to the South African platforms offshore. We do have the fund listed. And again, just to point out that if any of the products that one might use on the call and we're not there, please reach out to us or our business development managers, and we certainly then speak to the counterparties and we get it listed for you very quickly. But as I say, we are on, particularly the balanced fund is on most of the platforms that are used by the South African investor base. Back to you, Tian.
Yeah, so we definitely available on Swissquote. If you need an ISIN, so typically you just provide Swissquote with the ISIN. Feel free to get in touch with us and we can share the ISIN with you it's just the Prescient China balanced fund. It should be the only one on there. And then if I talk a little bit about balance, it's pretty much it's our flagship strategy. It's your all-in-one strategy. We do flexible allocation across China onshore, China offshore, China fixed income. And we do derivative structuring, we do arbitrage. It's sort of your all-in-one China strategy, and we're available everywhere. So I think one thing I forgot to mention is that in March this year, we actually listed this fund on the JSE, and the ticker is Panda. So easy to remember, PANDA, Panda, the special Chinese animal that's very cute and very cool. So if you search for it on the JSE, you can buy the fund directly in rands. And I think my understanding is if you invest by the JSE, it doesn't even count towards your offshore allowance. So feel free to check that out for easy access. But like Murray said, from a dollar perspective, we are available pretty much on every single platform, a mainstream platform. We're available on all funds, on Credit Suisse, on Saxo Bank, Credo, etc. So and all the major sort of South African lists, we're available. And then in addition to this fund, we have a Prescient China equity fund and a China hedge fund. So all our China strategies are Section 65 approved. We don't cover too much about specific fund details in the webinars, but feel free to get in touch with us. Our China equity fund is a onshore equity only. So you pretty much then don't get access to your Tencent Alibaba. One of the reasons why we launched that is onshore is a much bigger market. It's about $17 trillion versus the China tech part in Hong Kong is about $5 trillion. So it's about 3 times as large, or more than 3 times as large as China offshore. And then secondly, a lot of South African investors, actually all South African investors, are heavily exposed to Tencent, which is already heavily present in the China tech space. So if you already have your own stock portfolio with Tencent, Alibaba, Naspers, etc., then it makes sense to consider our equity portfolio, which is also available on Swissquote. So feel free to have a look there. And then our China hedge fund is it's a very structured product. We typically don't recommend coming in mid-year, but in the Q4 webinar, I will cover that. So typically it's almost like a rolling structured product type of strategy. It's a hedge fund. also Irish domicile, dollar denominated. So yeah, if there's any interest, feel free to get in touch with any of us, and we'd be very happy to
Great.
cover that. Yeah.
Tian, thanks very much. Very informative, and insightful, exciting. Good to see the performance, which is obviously always important to everyone. As mentioned, please reach out. I'm sure everybody has our email addresses, contact details, phone numbers, and the like. If we haven't answered your question specifically, please feel free to email us. We'll have a look through them again just to make sure we didn't gloss over any of the important ones, and we'll get back to you. And then just to finally say thanks again for joining us this morning. It's always a very big pleasure to have so many people join us on the webinar. Thanks for your time.